There's been a whole lot of news lately on Treasury yields rising, and I wanted to take the time to make sure everyone understands what is going on and what this all means. Let's start first with what a Treasury actually is. Well, it's kind of like a deal with the devil. Oh, I'm just kidding. Kind of, at least. When you buy a Treasury, you are pretty much lending money to the US government in exchange for a promise to be repaid at a later date with interest. Treasuries are the primary way the US federal government raises money to fund its operations. When the government spends more than it collects in revenues, like our tax money, there is a budget deficit. By no surprise, this has been every year for quite a long time now. I feel like I'm talking about my wife right now. Absolutely no concept of money. Although, even she would likely do a better job of managing our country's money, and that's pretty scary. Anyways, to cover this deficit, the government borrows money by issuing treasuries. Awesome, right? Those dirty little devils. So, to cover the debt, they issue more debt and the cycle repeats. Our economy basically runs off of debt. One of the large problems is that we've been doing this for too long and the debt is now too high. Too much money is going to interest payments and it's only increasing, so the problem continues to get larger and worse. Now, treasuries are backed by the full faith and credit of the US government. Sounds promising if you have 100% faith in the US government. If that's you, good luck. So, when you buy a treasury, you have a few different options. Number one, treasury bills or T-bills. These are short-term securities that mature in 1 year or less. They do not pay regular interest. Instead, they are sold at a discount to their face value, and when they mature, the government pays you the full face value. The difference between the purchase price and the face value is the interest you've earned. Number two, treasury notes or T-notes. These are medium-term securities that mature between 2 and 10 years. T-notes pay a fixed interest rate every 6 months and return the principal, or the face value, when they mature. Number three, treasury bonds or T-bonds. These are long-term securities that mature in 20 or 30 years. Like T-notes, they pay a fixed interest rate every 6 months and return the principal at maturity. Number four is Treasury Inflation Protected Securities, or TIPS. These are similar to T-notes and T-bonds, but the principal is adjusted by changes in the Consumer Price Index, or the CPI, a measure of inflation. They aim to protect investors from the negative effects of inflation. Funny enough, it's the same inflation that the government and the Federal Reserve has created. Imagine that. When you buy treasuries, there's two different ways you can do this. Number one is you can buy them on the primary market. If you're buying treasuries when they are first issued, you are buying them from the primary market, typically through a process called an auction. The U.S. Department of Treasury conducts these auctions themselves. You can directly participate in these auctions via the Treasury Direct website or indirectly through different types of financial institutions. Number two is you can buy them on the secondary market. Now, these are treasuries that have already been issued. In this case, you might be purchasing from another investor, a bank, a brokerage, or really any other type of financial institution. The U.S. government is not directly involved in these transactions, as you're buying a security that someone else has previously bought, right? Someone else previously owned it. Now that we understand what a treasury is, the options, and how they can be bought, let's talk about yields. In very simple terms, a treasury yield is the interest rate that you receive. If you buy a $100,000 one-year treasury bill with a yield of 5%, after 1 year you get paid back your $100,000 plus $5,000, or 5% of the $100,000. In more complex terms, it's the annual percentage return you can expect to receive. Now that we know what treasuries are, the options, how they are bought, and what yields are, you may be confused on why rising yields is a bad thing. Hey, rising yields mean you, the investor, makes more money. How's that bad? Well, what's the saying? The devil is in the details. Or, in this case, the devil is in the whole damn deal. Here's a few of the reasons rising treasury yields are a concern. Number one, higher borrowing cost. It can push up interest rates across the board. This includes mortgage rates, car loans, business loans, and other credit forms, and this can slow down consumer spending and investments in business, which of course can slow down the whole economy. Number two is a slower real estate market, and this of course ties into point one, but higher mortgage rates means less affordable housing, which means a slowdown. Number three is a negative stock market impact. Higher yields means treasuries and bonds become more attractive to investors. This means people investing more money into them instead of the stock market, pulling money out of the stock market to put into treasuries and bonds, or both of these things together. And number 4 is the word we've all been hearing a lot lately, inflation. Rising yields can oftentimes indicate that investors expect higher inflation in the future. And number 5 is rising cost of government debt. And this is a big one considering our current situation. We already have a ridiculous amount of federal debt, and it's growing quicker and quicker. It's already at a point where it can't be paid back. It's virtually impossible. And higher yields means even more interest payments on the debt the government is creating. Here's a graph of our national debt from 1790 to 2022. Now, it doesn't take a graph analyzing genius to figure out that our debt is growing exponentially. In layman terms, not only is our debt increasing every year, but it's growing at a faster and faster rate. In 1971, when the gold standard was abandoned and we went to 100% fiat currency, is when the main problem started. From that time in 1971, we have accrued more and more debt at a faster and faster rate. And we are at the point where it's growing so quickly that we are futile. That's what I meant the whole time. We are screwed. Here's a stat for you. In 3 months, from June 2023 to September 2023, we created $1 trillion in debt. As you can see from this chart, we hit the first $1 trillion of debt in 1982, and it took almost 200 years to get there. And more than half of that original trillion came in the last 10 years of that 200 years. And earlier in 2023, we hit $1 trillion in 3 months and 3 days. And then we followed that up with an additional $500 billion in debt in just 3 weeks. So, although rising treasury yields are a concern for the 5 reasons I listed in this video, the bigger reason for me is what I just talked about. This makes our whole enormous problem gigantinormous, if that's even a word. Make sure you like this video to help your karma, and of course, spread the word to other people. Visit Tim and I at tageconomy.org to join our newsletter and get important market updates. And subscribe. At least 3 videos a week, every week. Don't miss them. See you soon.